Pgim's Greg Peters expecting central bankers to tighten their focus on inflation following the latest vaccine developments. He writes the following: given the prospects for the aggressive asset purchases to continue, we believe global interest rates will remain low, subsequently limiting the potential increase in US long-term rates going forward. I'm pleased to say that Greg joins us now. Greg, Deutsche Bank wrote something similar to this morning. They looked over to Asia, essentially said if things are good in China right now, the recovery's strong and they're getting downside surprises on inflation, why would you think we'll get anything other than that in the United States, Europe and beyond? Your take, Greg?
No, I completely agree. I don't see what's changed fundamentally from an inflation standpoint pre and post. If anything, I see a more difficult inflation regime going forward. So you look at just the massive amount of debt's been added that pulls down inflation. Growth is, slated to spurt up, but then come back down. You're seeing that already. We're waiting for more fiscal stimulus. So to me, this inflation rise is more of a hope than anything else. So I see real value in U.S. Treasuries, 10 years, 30 years, as I think the market has really been banking on this reflation trade that I really don't see materializing. So I don't know. And it's tied to the risk markets as well. So Wilson just talked about calling for a 140 10-year. I think it's really hard for risk markets to do well in that type of yield environment. So to me, the world needs low interest rates, and I think central banks will help deliver that.
A real recognition of how difficult it will be to get anywhere near 140 between now and year end. The story seems to be around the hope of 2021. And Greg, to your point, it's just about tolerance levels. We've added a lot of debt to this economy. How tolerant will we be of higher interest rates? You brought up credit. Let's sit there for a moment. Your long US duration, 10s and 30s in the Treasury market. Walk me through the credit call now, Greg.
Yeah, so credit has rallied a lot, obviously, since March. It was just absolutely cheap beyond recognition. It was just so dramatically attractive. That's changed to a large degree, but there's still lots of value within the credit market. What's really interesting to me continues to be in several areas. The BB and BBB space look completely dislocated to me vis-a-vis other parts of the credit market. Long duration IG looks attractive as well. And what's notable is that the CCC part of the high yield market, yields are actually, or spreads are actually tighter today than they were pre-COVID. So there's such a bet on this reflation trade that, to me, it's overextended, and so that's not where the value is.
Greg, I wanted just to finish on the short end of the yield curve in credit. What we saw back in spring was a huge dislocation in short-end credits in investment grade and high yield alike. Can you walk me through how much the maturity profile has changed? I talked about this a little bit earlier on Bloomberg TV and radio. Do you think the maturity profile of some of these big companies has changed enough, that they've termed out the debt long enough, that if we do have some choppy months ahead of us, similar to what happened in spring, we don't see a repeat of what happened in the credit market?
Well, I'm not sure you won't have a complete repeat, but you have seen this terming out. So it's been a real positive move in credit since March. So there's been this massive amount of issuance. So companies have taken out short-term debt, added longer-term debt at lower coupons. So that's a real benefit. It creates that operating leverage to the cycle. So to me, kind of perversely in here, since March, the credit profiles, even with cash flows getting absolutely destroyed, is actually better and better for the future. So I do think it puts companies in a less precarious place. But there is a big difference between these investment grade, high yield companies, these larger cap type of companies that we invest in versus these smaller kind of medium-sized businesses that don't have access to the capital markets. And that's where the struggle is. And quite frankly, that's where the stimulus needs to be focused on. So to me, there's two separate parts of the credit market, and the public market is in way better shape than the private market.